Well, my next guest says that the Federal Reserve's decision to buy treasuries and keep interest rates low will support risk assets without bringing down unemployment. I'm joined now by Tony Crescenzi. He's the market strategist and portfolio manager at Pimco. Nothing fake about him. He's also the author of The Strategic Bond Investor, Strategies and Tools to Unlock the Power of the Bond Market. Tony, good to have you with us. And, you know, I know after the Fed decision, you were saying that, look, this could take people out further on the risk spectrum, right? They could actually bring on risk more. But all you've seen is risk off in the last 24 hours or so.
Right. The effort since November 2008, when the Fed first announced its asset purchase program, was to push investors to move out the risk spectrum. That effort, of course, has been successful. You could see that in the sharp movement up in stock prices since then, and the sharp tightening in credit spreads since then. Of course, right now, there's such an unusually uncertain environment, as Ben Bernanke said 2 weeks ago, that the Fed is trying to reduce that to as much as they can, because uncertainties are risks that can't be measured. And when uncertainties are brought into the equation, as John Chambers is saying, and you'll see him on your show, you said, in about 20 minutes.
Yes, in about 10.
The idea of reflexivity, which is that the markets and economic agents create their own realities, starts to get introduced during these periods of uncertainty. And the Fed, to the extent that it can, is trying to remove them.
Right, and they're trying to stabilize, stabilize the rates and take the volatility out. But you've seen the opposite happen. And I know some might say, look, you can't tell from just watching the last few hours what's going on. But I mean, that's got to be disappointing for the Fed if they see that there's actually more volatility.
Well, the Federal Reserve, of course, has a much longer-term perspective on things, and I'm sure is probably looking past the last couple of days, except to the extent that it'll look at the way it communicates with markets.
Except, though, that, Tony, that this is the wrong reaction that they wanted. Yes, I mean, they're going to look beyond what's happened, but this is the wrong reaction.
Well, remember, in 2008, there wasn't an immediate reaction either, and what it did also was cause a sharp movement down in yields because the perspective about the economy was similar in the sense that there was a negativity. But it took a little bit of time. Remember, it took till March of '09 until it was risk on. It was many months. And so the Fed will hope that this is a short-term reaction and that the effects of its actions, which is the purchase of securities and the impact it has on interest rates, will, in fact, push investors to move out the risk spectrum. It's a natural inclination, of course, when yields are this low, to seek higher yields or higher returns in other assets. And so that is what the Fed is engendering to do here.
Tony, very quickly before you go, it's John Erlichman. The jobless claims data this morning made it start to look like 2002, 2003, when jobless claims were rising, and we solved that by seeing lower mortgage rates, which obviously the Fed is hoping for with this time around. Do you buy that? Do you think that's going to happen? You're going to see a flood of refinancings, yes or no?
Not a flood of refinancings, not like the waves we saw before. The Mortgage Bankers Association has an index, the base year, March 1990, and it's gotten as high as 10,000, and we see it now at 4,000, despite the record low interest rates. And so it's because many can't refinance because the bankers won't let them.